The World Bank has cut its 2019 growth forecast for sub-Saharan Africa to 2.8% from the initial 3.3% projection. The slowdown in the growth outlook is based on the bank's belief that the continent's recovery from the 2015 global commodity slump would linger, contributing to the trade dispute between China and the United States. In its latest report on the region, the Bretton Woods institution predicts that sub-Saharan Africa's economy will also hinder its rapid population growth for the fourth year in a row. The downward revision highlights macroeconomic instability and poorly managed debt, inflation, as well as deficit in key economies such as Nigeria, South Africa, and Angola. Meanwhile, a growing debt pile and weakening currency has set Zambia's economic growth back by 0.2%. According to the World Bank, the Southern African nation's dwindling economic growth, which is pressuring government revenue, now stands at 3.3% as against the 3.5% seen last year. However, spending remains elevated in the country, and there is a struggle to raise revenue for expenditure finance. And Kenya's growth forecast for 2019 has also been sliced to 5.7% from 5.8% predicted in October. The World Bank's downward projection follows dry weather conditions across most parts of the mostly agrarian country, as the long rainy season due from March till May is still being anticipated. Kenya could suffer from macroeconomic shocks if the government fails to meet its revenue collection targets. The World Bank, which is one of Kenya's biggest development financiers, has asked the government to cut back on tax holidays to boost revenue and adopt a more realistic stance towards revenue forecasts. And now a quick crossover now to the equities market for update on today's trading. Temple Ashaju joins us now. Good afternoon, Temple. So what's the market's performance at the moment? At Intra-Day, we saw the market still down. What's it looking like at the moment?
Still down, Chimeze. The market is still down right now. We've got some 0.18% decline in the key benchmark indices. And of course, the sell pressure basically just continues and continues to also leave a negative impact on the equity capitalization. We're still seeing losses across major counters. The banking segment is down right now, some 1.32%. Consumer goods segment is also down some 0.22%. A few minutes ago, we saw the oil and gas segment of the market also joining some of these losers in the market. You have noticed that O&O for a while now has actually risen high to some 5 naira plus yesterday. But so given that level of appreciation, it's time for some investors to also take profits on it, and that's what we're seeing. So it's down some 3% as we speak. But if you look at the losers chart, which is where we have the major drugs in the market, the insurance side of things is really weighing down on the market right now. NEM insurance has lost some 9.3%, and that's really impacted that sector negatively, coupled with the losses that we've seen from a couple of other counters on that particular sector. The consumer goods segment of the market is also critically down. Dangote Sugar is down. MC Nichols is also down, as well as a couple of other names that you have there. But if you take a look at what we have in other sectors like the industrial goods segment of the market, we haven't really seen much difference. It's currently flat as the bulls and bears continue to drag that sector for dominance. Today, that's what we've seen so far. In terms of recovery, we're not too sure of any recovery in sight right now, given the fact that yes, a lot of analysts, a lot of traders here too have noticed that the market has been down some to the 29,000 psychological line, and the argument is that will it remain at that level or it will eventually move back to 30,000 psychological line, as we've seen historically, where we see the market at that level, 29,000 psychological line, for some 2 trading sessions, and by the 3rd trading session, given the fight for dominance between these bulls and the bears, you see the markets moving back to 30,000 psychological line. But with the way things are going right now, we're likely to see the market at these levels, 29,000 psychological line, if not even 28,000, with the way things are going, as the sell-off persist because there's basically no catalyst in the system to drive up the performance or drive up demand on these particular stocks. But however, a bit of bargain hunting is likely to set in any moment from now, because yesterday, for example, we were able to see a couple of companies on offer, and eventually a few buyers, set into buy the mess. So, but that's not enough, because we're still seeing the sell side of things outweighing the buy side. And so you see a lot of investors that are currently sitting on the fence, waiting to see how things will pan out. They don't just want to put down money right now at a bit of a support or resistant level, and at the end of the day, some major investors will come in again and then pull out of the market, especially with the way the institutional investors are currently outperforming the sell side of things in the market. So investors here are being cautious. Traders as well are being cautious. Some of them just come in and just take a seat and continue to watch the numbers as it continues to crunch in the rain before they now set into see how decent counters will be available for a buying. So that's the kind of sentiment we're seeing. A lot of people are just cautious. They're waiting to see how things will pan out before the end of this week. Today is Tuesday, and so we'll see how things go by tomorrow midweek before we then can judge, what shape the markets will be taking going forward, Chimeze.
All right, thank you, Temple. We move on now. Oil prices eased today, slipping away from the 5-month highs reached earlier in the session as a sluggish economic outlook countered the tight market. International benchmark Brent futures softened to $70.96 a barrel, while U.S. West Texas Intermediate crude oil futures were at $64.36 a barrel, 4 cents below their last settlement. Traders say that despite generally bullish oil markets, concerns that an economic slowdown this year will hit fuel consumption having led to a slowing in crude prices. And finally, metals market. Gold prices were higher today, trading close to a more than 1-week high touched in the previous session as the dollar eased after weak U.S. economic data. Spot gold rose 0.2% to $1,299.59 per ounce, while U.S. gold futures were up 0.1% at $1,303.30 an ounce. Among other precious metals, spot platinum was down 0.1% at $904 per ounce after touching its highest since the end of May 2018 in the previous session. Palladium slipped 0.5% to $1,376.07 an ounce, while silver gained 0.1% to $15.26 per ounce. And that's it on the program. Thank you very much for watching. I'm Chimeze Obi Iwago.